Hi and welcome to Swissquote's Daily Market Talk. It's Monday, the 1st of September. A group of EM nations led by China and India promised to strengthen their ties against harmful US policies, while a federal appeals court in the United States maintained that tariffs are illegal. Anyway, last week's US PCE data, which is the Fed's favorite gauge of inflation, was just too perfectly in line with expectations, raising worries and doubts about the accuracy of the latest numbers, while the US will be revealing the first set of jobs data after the BLS chief got fired. Remember? Last month for having made big revisions to prior month's figures. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the Chinese equities hit a fresh 3-year high while Nifty 50 in India rebounded this Monday after Xi Jinping and Narendra Modi gathered in a summit in Shanghai this weekend. A summit actually including other major EM nation leaders as well, like Russia, Iran, and Turkey. So the goal here was to strengthen the ties between these countries faced with aggressive and harmful US policies to their economies. So the Chinese President Xi Jinping insisted that the right choice now is to be friends. It sure is, as long as geopolitical tensions allow, of course. But things may get moving as Indians now face 50% tariffs on their exports toward the United States, and many factories in the country are already cutting their employees and reducing the size of their businesses due to piling stockpiles. Same applies to all of those who export to the United States, EM or DM countries. In Switzerland, for example, the ZUE expectations tanked considerably in August, obviously due to the announcement of 39% tariffs on the Swiss US exports, and the economy slowed more than expected in the second quarter as well. So this economic slowdown in Switzerland will likely accelerate in the coming months as many companies that were actually doing their business in Switzerland so far are now looking to delocalize, if not as far as to the United States, at least to the European Union countries where they could reduce their tariff cost to 15% from that whopping 39%. So the SMI index in Switzerland has indeed rebounded much slower than the European peers since April, and the Swiss franc strength is not helping obviously the matters, and the negative phrase could well be in the horizon for Switzerland in the second half of this year. Meanwhile, in the US, a federal appeals court actually maintained that tariffs imposed to countries by Trump administration were illegal. But illegal or not, they are heavily weighing on many economies' health today, and they will be remaining in place as appeals and discussions around these tariffs will continue. So with all this unease around tariffs and global tensions, the US dollar index kicked off the new week on a negative note this morning in Asia, while the futures, the US futures, are actually flattish ahead of US bank holiday today. Many out there are actually warning that September is a weak month, historically speaking, with an average rate of return of negative 0.7%. But we also know that the Federal Reserve will help, if not, will be forced to help with lower interest rates in the US. Now, the all-important core PCE data on Friday, which is also known as the Fed's favorite gauge of inflation, actually came in exactly in line with market expectations. The core PCE actually ticked higher from 2.8% to 2.9% on a yearly basis in July, while the headline PCE figure remained steady near the 2.6% mark. So there was no surprise. What was, however, very surprising was how close and how incredibly in line this data was compared with the expectations. So many pointed out that it was almost too much in line to be true. Of course, we don't know if there was any tweak to make the data match the market expectations, but the simple fact that many people actually now doubt about the accuracy of the economic data in the US is a real issue. It means that the BLS, after the replacement of its head on unpleasant jobs numbers in August, has already lost a bit of its credibility. And that's maybe why the markets didn't exactly react with much joy to the data release on Friday. That could have actually triggered joy and purchases a month ago because of softening Fed expectations. So this brings us to this Friday's jobs data in the US, the first data release after August numbers unleashed Trump's rage and led to the firing of the BLS chief, as I said earlier. So a consensus of analyst estimates on Bloomberg actually predict that the US economy may have added around 74,000 new non-farm jobs in the month of August, and the unemployment rate in the US may have ticked just slightly higher during the same month. Now, God knows what kind of revisions will be made to the earlier month's figures, but the mass deportations in the United States since Donald Trump took office probably explain why jobs are crumbling so rapidly in the United States and why we have such big revisions to the prior month's data. And note that the Federal Reserve cuts may not reverse this trend that is politically backed and not necessarily economically justified. What could reverse the trend of slowing jobs market in the US, however, is manufacturing jobs coming back to America. So that obviously won't happen overnight. And to make that transition easier, Donald Trump needs lower interest rates from the Federal Reserve. So the roadmap is getting clearer by the day. As long as inflation remains in check and the BLS could actually be mandated to make sure that inflation numbers look like they are in check, the weakening jobs market in the US will justify lower interest rates from the Federal Reserve. So this situation will probably continue to put some additional downside pressure on the US dollar. However, the dollar has already faced significant selling pressure since the beginning of this year, remember, and the fact that the positioning in the market remains heavily negative means that the downside pressure could still be limited on the US dollar. As for the stock market, lower rate expectations will likely continue to support equity valuations, especially as long as corporate earnings and economic data from the United States do not point at a dangerous economic slowdown. In other words, the dip buying will likely be on the menu du jour, that despite trade and political uncertainties around the United States. Here in Europe, we had a few inflation numbers to analyze as well. The French and Spanish CPI updates came in softer than expected on Friday, while the German figures surprised to the upside. So this mixed view on mixed inflation data sent mixed echoes across major markets. The euro-dollar, for example, eased against the US dollar, but the greenback's broad-based weakness is weighing heavier this morning in Asia. The pair is actually back to 170 mark this morning before the market opened, but upside could be limited on worries of a potential government collapse in France next Monday. So I expect to see some thick offers into the 118 psychological mark. On the data front, the aggregate estimate for the euro area CPI data is due this Tuesday. The headline figure will likely land somewhere around the 2% mark, which is the ECB's inflation target, and will give time to the European Central Bank to pause its interest rate cuts in September and decide what to do next when the time is right. So the European Central Bank rates look like they are not too restrictive and they are not too supportive either right now. So the latter hints that the euro dollar is more likely to find its next direction with the US dollar and also with the French political news, while the equities across the euro area economies could bear the brunt of French political uncertainty in the short run, but that could open the way for dip buying further down the road. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.